Why your diversification strategy might be killing your gains. Do you think spreading your investments is always safe? Think again. Your diversification plan might be the reason your portfolio underperforms. Are you playing it too safe? Diversification. It's the golden rule of investing, the mantra repeated by every financial advisor and seasoned investor. Don't put all your eggs in one basket, they say. And it sounds like solid advice. Spread your investments, minimize your risk, and enjoy steady growth over time. But what if this sacred strategy is secretly holding you back? What if, by playing it safe and spreading your money too thin, you're missing out on real wealth building opportunities? While diversification is a cornerstone of risk management, too much of it can dilute your gains and keep you tethered to mediocre returns. Let's unpack the pitfalls of over-diversification and explore how to strike the right balance to maximize your portfolio's potential. The common misconception about diversification is often sold as the ultimate safety net. The idea is simple. By spreading your investments across various assets, industries, or markets, you reduce the risk of losing everything if one sector underperforms. But here's the catch. 1. Over-diversification can dilute potential gains. 2. It can make it harder to outperform the market, especially if you're investing in too many low-performing assets. 3. It's a strategy that prioritizes avoiding losses over maximizing profits, a trade-off that might not suit your financial goals. What if Warren Buffett diversified into hundreds of stocks instead of focusing on his high-conviction picks like Coca-Cola or Apple? Would he still have become one of the richest people on the planet? The pitfalls of over-diversification. 1. Mediocre returns. When you spread your investments too thin, your portfolio begins to mimic the broader market. This essentially locks you into average returns. Example, if you own a dozen index funds that all track the S&P 500, you're unlikely to outperform the index because your holdings are too similar. 2. High costs and complexity. Managing a highly diversified portfolio can lead to increased costs, such as 1. Transaction fees. 2. Fund management fees. 3. Time spent researching and tracking a large number of investments. Too many moving parts also make it harder to maintain a clear investment strategy. 3. False sense of security. Diversification isn't a guaranteed shield against market downturns. During global financial crises, like in 2008 or 2020, most asset classes dropped simultaneously, leaving even diversified portfolios exposed. 4. Dilution of high-performing assets. When you over-diversify, gains from your best-performing investments are offset by weaker ones. Example, imagine investing equally in 20 stocks. If one skyrockets by 200%, its impact on your portfolio will be minimal because the other 19 stocks dilute its weight. How to diversify smarter. If over-diversification is killing your gains, how do you find the right balance? 1. Focus on high-conviction investments. Instead of spreading your money across dozens of assets, concentrate on a smaller number of high-quality investments that you understand deeply. Warren Buffett's philosophy. Buffett once said, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. 2. Diversify across asset classes. Not redundantly true. Diversification means spreading your investments across uncorrelated assets. This includes 1. Stocks and bonds, balancing high-risk equities with stable bonds. 2. Real estate, adding tangible assets to hedge against inflation. 3. Alternative investments, venture into gold, cryptocurrency, or commodities for added diversity. Avoid redundancy, such as holding multiple index funds that track the same market. 3. Consider your risk tolerance. Over-diversification often comes from fear. Ask yourself, how much risk can you reasonably handle? If you're too diversified, you may be sacrificing potential gains unnecessarily. Pro tip: use tools like the Modern Portfolio Theory, MPT, to identify the optimal risk-return balance for your portfolio. 4. Rebalance. Periodically review your portfolio regularly to ensure it aligns with your goals. 1. Sell underperforming assets. 2. Reallocate funds to high-performing or undervalued investments. Rebalancing prevents your portfolio from becoming over-diversified over time. 5. Use technology to simplify. Platforms like Personal Capital or Wealthfront can help you analyze your portfolio and identify areas of over-diversification. A real-life example, the case of Apple. Consider the story of investors who held significant positions in Apple stock over the last 20 years. Apple's share price grew over 1,000%, delivering life-changing gains for early investors. Now, imagine if those investors had sold off portions of their Apple stock to diversify into a broader mix of average-performing companies. Would they have seen the same level of financial success? Likely not. Apple's story illustrates the power of holding on to high-conviction investments rather than diluting them with less promising assets. The balance between risk and reward. Diversification is not inherently bad, it's a critical tool for managing risk. However, like any tool, it needs to be used wisely. Ask yourself: 1. Are you spreading your investments too thin out of fear? 2. Are you investing in assets you truly believe in, or just following the crowd? 3. Could simplifying your portfolio actually lead to better results? Finding the right balance between diversification and concentration can help you maximize gains without exposing yourself to unnecessary risk. Closing thoughts. Is your portfolio too diversified? Take a hard look at your investments. Are you guilty of over-diversifying? Are you holding assets you don't fully understand or believe in? Remember, the goal of investing isn't just to avoid losing, it's to grow your wealth meaningfully. By focusing on high-conviction investments and reducing redundancy, you can create a smarter, more effective portfolio. What do you think? Have you ever experienced the pitfalls of over-diversification? What strategies do you use to strike the right balance? Share your thoughts in the comments below. Your insights could inspire others to rethink their approach. Please like and subscribe.